on the 29th of September 2019. This week in economics from WBRN Radio and on the Bostonred Network. This is the economic side, normally known as the Numbers Man section, and the program is the Numbers Man Show, which you can find on YouTube, on Spreaker, Stitcher, iHeartRadio, a favorite of many. That's around the world. You can find on iHeart, or you can do it on Stitcher. Stitcher's a mobile platform. The same with YouTube and Twitter. Twitter can be mobile or not mobile. Doesn't matter with Twitter, nor with Facebook. We are around on those various social outlets here, talking about the economy from a macro perspective. And today we have GDP numbers, the latest ones out. The latest report from the people at the University of Michigan, Professor Dr. Curtin there, and from the Conference Board in New York. They've been in the business for a very long time. And commentary from Reuters, CNBC. I believe there's also Barron's there briefly. And you have, I don't know, we had the BBC this time. We normally always have them. We change it up a bit as far as whom we have. And, of course, we give some commentary as we run along. We partner with Cranston Analytics. As far as the modeling, we use a model called the Seesaw model, which is definitely where it should be today. The economy is sort of going up, going down, particularly when we look at petroleum pricing. For those who recall, a geopolitical event happened when some of the oil fields in the Kingdom of Saudi Arabia were attacked by drones. The actual attackers had never really been clearly pinpointed. However, there is a temporary agreement now between the Kingdom of Saudi Arabia and the Yemenis government, and the Yemenis that are fighting there, the Houthis. So thus the price is stabilized, and now they're back to basically where they are, around $55 a barrel. Now, a number of things happened there. First of all, it knocked out roughly 50% of the Saudis' output, and the Saudis went to reserves. The U.S. said they would tap reserves. That came from the Trump administration. But one of the biggest elements was a downturn in world productivity, or manufacturing, let's just say that. So now the issue is not a glut or an oversupply, but actually an undersupply of petroleum product out there. So where this will go is very, very interesting. At one point, we would have went to $80, $90, $100 a barrel, at least temporarily, but a number of things also factored in, particularly in the U.S. and in the UK. The summer driving season, it was over. Manufacturing is not what it used to be. And the consumers, basically, consumerism continued in the U.S., although it's beginning to get a bit more subdued out there. People are not talking about a recession, but they leave it out. The Fed, because of some inflationary pressures, are wondering if they will lower interest rates once more this year or not. That would be probably 25 basis points, of 0.25. They're at now 1.75 or 1.75 basis points, however you want to put that out there. And there was, as we reported last week, there was some dissent in the committees. That's the Open Market Committee's report. And the chair, Jerome Powell, we had his. You can go back to that broadcast, his presentation, news conference, and the Q&A is, the link is attached to that particular situation there. Actually, not the Q&A, I'm sorry, the actual audio, this is from the Federal Reserve, is part of the program, I believe. And anyway, nonetheless, we covered that in a basic manner there, as we normally tend to do. So what we're going to attempt to accomplish here, we'll have various views, and we will comment on some of those from Reuters. And the Reuters piece is basically a roundup of views from various standpoints. Let's go first. This is Reuters on the 27th of September. Wall Street's week ahead. That's the week coming up here. Data will show damage of tariffs. Strong dollar on goods. This clip by Stephen Culp is no longer. It's no longer a probability. It is a reality. The escalation of U.S.-China trade conflict. They call it a war. We'll call it a conflict. The strengthening of the dollar appears to be inflicting measurable damage on U.S. Goods makers that rely on the global markets. Market participation will get a picture of participants, a picture to the extent which trade tensions and currency, and it is currency here. The Institute for Supply Management, our friends out of Tempe, Arizona, will release their purchase managing report, and the PMIs there for September on a Tuesday. And incidentally, Tuesday, the 1st of October, is the 70th anniversary of the People's Republic of China. The August report showed that manufacturing sector accounted for 12% of the U.S. economy, contracting for the first time in 3.5 years or 3.5 years, and more worrying, export component hit a 10-year low. Exporters are at least a half step or a full step closer to a predicted recession. Now, this is from Robert Pellick, a chief investment strategist and senior portfolio manager at Statestone Wealth in New York. The PMI was below 50%. 50% is neutral. The August report, new export orders plunged to 43.3%, the lowest since 2009. That was the beginning of the Depression. China already has implemented tariffs on about $110 billion in U.S. goods. In return, DJ Trump's tariffs on China imports. Beijing announced additional retaliatory increases in August. The first took effect at the beginning of this month, and the second is due on the 15th of December. U.S. goods already have become more expensive on global markets due to a stronger dollar, and which has boosted by simmering geopolitical unrest. We talked about that. Markets rattling tilt for tariff hikes from Washington to Beijing. Geopolitical tensions do two things. This is according to Peter Toons, president of Chase Investment Council in Charlottesville, Virginia. They compel big companies to set back and not spend as much as they would. Well, uncertainty is there, including the I word, the impeachment situation. We don't have any data on it, but we'll look. The dollar index, .DXY, which measures the greenback against a basket of world currencies, hit its 29-month high on September the 3rd, the very day the ISM released its dismal PCI report. Indeed, the first quarter of 2018, during which Trump fired the opening salvo, that's a trade war, corporate earnings were estimated at 40 million North American corporate earnings, according to the cloud treasury source Wirtschaftsprognose. 1 year later, that has ballooned to $223.4 billion. That's a negative impact of currency. Let me just make that straight here. The arrival of Q3 earnings season next month will provide a clear picture of the damage of the trade war. We at this mic have minimized the trade war in terms of its impact. Now, we do have currency here, which for us is much more than trade. Over the last year, third quarter analysis earnings estimated from a basket of 15 top exporters by dollar value have dropped by an average of 17.3, according to Renivit data, and by 12.3 in the last 3 months. Now, these are some of the earnings here that have dropped. We start with Micron. They make memory chips. Non-U.S. Percentage total is 81.1%. Boeing at 55.8%. Qualcomm, at 97.4, GE at 61.5, Ford at 39.2, 3M Corporation at 60.8. We won't get all these. Johnson & Johnson 48.7. Now, and we look at the different earnings in September of 2018 and to June of 2019. GM is at 20.7. This is the percentage in earnings estimate, non-U.S. revenue there. Anyway, these are what is happening with some of these corporations here. Broadcom, another chip maker, 87.1. United Technologies, 41.8. The fourth quarter estimates for the same companies have been revised down 15.6% since September of 2018 by 10.3%. And so we get to Apple. They are 7.4% lower than they were a year ago, and down 16.7% for the essential October, December. We'll be watching very closely. Holiday a quarter. Non-U.S. revenue contribute 63.1% to the iPhone maker GE. Sorry about that. Gets 61.5% of its revenue from abroad. Now, these are major corporations here. Analysts currently see the conglomerate's third quarter earnings coming in at 44.6% below the level seen last year. Not good. And it's estimated are now for Q4 down 43.5%. Chip makers particularly vulnerable to trade concerns. Micron relies on non-U.S. business for 81.1% of its revenue. Third quarter estimates for the company have plunged 84.4 over last year and 42% from the last quarter, Q3. Overseas customers contribute 97.4 to Qualcomm's revenue. Estimates have slashed their third quarter earnings estimates by 47.7. I think we gave most of this. Nike, the people that make shoes, they derive 62.5% of its revenue from overseas. Reported its first quarter earnings for fiscal 2020 on Tuesday. Sportswear company's revenue and profit beat analyst estimates. But it said currency and trade concerns remain headwinds there. And no doubt they will come in here. Manufacturing side of our economy is in the early stage of a recession, and we're hearing that more and more. That's 12% of the economy. We should be concerned about the possibility of a full recession spreading here and around the world. That is from Tim Gorinsky, Chief Investment Strategist at Inverseness Council. Is in New York. If PCIs and if the ISM PCI export numbers remain weak, that will point to deeper overseas weakness. That's Gorinsky added, but strong numbers would surprise me given what's happening around the world. Now, yes, you can have up and downs here. This is from the Reuters agency here. From Reuters on the, 27th of September, consumer spending briefly rose in August. Business investment remains subdued, and lingering trade tensions prompting economists to slash their economic growth estimates for Q3. from the Commerce Department. Thanks to lower employment rates in 50 years. We kind of discount that because what happens with employment rates or unemployment rates after so many months of it, or if there's a trend for, say, 12 months or more, it becomes more or less a routine or normalization, period. Fed, of course, cut their rates there. We expect the Fed will cut rates in Q4, but squaring this soft read on consumer business investment slightly rebounding, underlining inflation admittingly pulls the Fed in an opposite direction. That's from Tim Quinlan, a senior economist at Wells Fargo in Securities. Consumer spending, which accounts for 2/3 of the economy, edged up only 0.1% last month, increasing on outlays of recreation goods, motor vehicles. Well, this is the start of the season. I've seen a few new cars around. We'll get to Michigan in a minute here. Period. Consumer spending has been robust, somewhat early this year, so slowing it is not a surprise. No doubt about that. People have basically spent their discretionary income early in the season. That happens more now than not. The Commerce Department orders for non-defense capital goods, excluding aircraft, closely watched proxy for business spending dropped 0.2% in August. You could expect that to happen. Shipments of core capital goods rose 0.4% last month, and we talked about Jerome Powell. The weakest core capitalist good data tempered consumer spending led economists to cut their Q3 GDP estimates by as much as 0.6 of a percentage point to as low as 0.3% annualized rate. The economy grew at 2% rate last quarter, slowing from January. March they were at a brisk, that just unsustainable, at 3.1%. We'll go over this in more detail here. Personal income in August, after nudging up 1/10 the prior month, wages increased 0.6, but personal income fell for the second straight month because of the rate cut. Income at the disposal of consumers after tax increased a solid 0.5%. Income growth outpaced spending. Savings rose to 1.35 trillion from 1.29 trillion in June. Quite a bit of money there. The savings rate increased from 8% last month. Increased to 8.1% there from 7.8%. That is always a positive sign, and with the exception being July, savings rate has held above 8%. There is no doubt what would be the prediction based on the strength of household balance sheet, lower levels of interest, which discourages savings. That is from Michelle Girard, the chief economist at NatWest Markets, that's in Stamford, Connecticut. Wages and salaries have outpaced expenditures this year, giving consumers a good amount of cushion to sustain their spending. Now let's go to Michigan and the survey there at the University of Michigan. The index of consumer sentiment in September this month is at 93.2. It was at 89.8 in August this year, and in September of last year was at 100.1. The change is a plus 0.38, and year to year would be a negative 6.9%. Current economic conditions are at 108.5. In August, they were at 105.3. In September of last year, they were at 115.2. The net change there is a negative 5.8%. The index of consumers at 83.4 now in September, and in August it was at 79.9. In September last year, 2018, it was at 90.5. The change, the month-to-month change, plus 1.4%, and year-over-year it was 7.8%. From Professor Curtin, my pointer went kind of wild here. Consumer sentiment continues to post small increase throughout September due to more favorable income trends, especially amongst middle-class households, and that is to be expected. And how they define middle-class households, we won't quibble too much on that. There are 50,000 GM workers out there, and economically speaking, those workers would be included in quote-unquote middle-income households. The overall trend in sentiment index remains quite favorable, but has shown some sign of a slow erosion. The sentiment index for Q3 of 2019 at 93.8 was only slightly below the average for the first half of 2019 at 96.5, as well as for 2017-18 at 97.6. Despite high levels of confidence, consumers also express rising levels of economic uncertainty. Some of these concerns are rooted in partnerships, some due to conditions in so-called global economy. As Brexit plays very high there, not so much as Saudi Arabia, but China and perhaps Iran, depending on where it goes. Trade policies have the greatest negative impact on consumers, with a near record one-third of all consumers negatively mentioning trade policies in September, when asked to explain in their own words the factors underlying their economic expectation. Those and other policy concerns have so far been held in check by positive finance. In other words, if people have cash on hand, they are a little reluctant to have some confidence. All indications is, at least now, that some consumers have savings on hand, and we'll have to look and see how the holiday season is financed and monetarily, and also at the same time what the retailers offer as their incentives that people that absolutely need these products. As far as headsets, iPhones, Samsung, Android phones, etc., you can expect a lot of people, unless they have very old phones, not to upgrade. And also we have 5G technology, 5G phones coming onto the market. Will there be upgrades in Q4 or in Q1, Q2 of 2020? That was more of there. Consumers now anticipate higher wages or lower rates of employment in the year ahead. Unemployment, Well, the unemployment rate pretty much remains about the same as the participation rate. There are not hundreds of thousands of workers entering the economy, so thus the participation rate will be lower in the outer years. Now, as far as higher wages, well, a lot of that will depend obviously on where the economy goes, and Professor Curtin has put in here these and other policy concerns. Somewhere here, impeachment diverts the attention of the President and Congress away from economic policy and may become flattened with partisan strategies, while the outlook is for a slower but positive growth in consumption. The outlook is contingent upon only modest impact on jobs, wages from an array of potential issues facing the economy. A good way of putting that, but at the same time, a lot of this will depend on external geopolitical situations such as Brexit. Now, at the end of October, the EU is supposed to leave the European Union with or without a deal. Will that be negotiated out? What about the various machinations surrounding the Prime Minister Johnson? And now Parliament is back in business in the UK. All these things on the UK, and of course the companies in the US are directly affected by the UK that have not moved out of the City of London area there. Some are banking there, etc. We'll look and see where that goes. So let's move on here. And just looking at a little roundup here, we already talked about Reuters, consumer confidence, Netflix, etc. appears there. They've been doing real well. Waning consumer confidence might sink the stock market. That's from Barron's. Anyway, very short headline there. Didn't read the whole headline. But now we'll go to the conference board. The conference Consumer Confidence Survey, a reflection of prevailing business conditions, and likely developments for the month ahead. The report details consumer attitudes, buying intentions, etc. Confidence index decreased in September, following a slight decrease in August. The index now stands at 125.1, down from 134.2. The present situation index, based on consumer assessments of current business and labor markets, decreased from 76 to 169. The expectation index, based on consumer short-term outlook for income, business, and market conditions, declined from 106 to 4 last month to 95.8 this month. Consumer confidence declined in September, following moderate decline in August. That is from Lynn Franco, the Senior Director of Economic Indicators at the Conference Board. Consumers are less positive in their assessments of current conditions, and their expectations regarding the short-term outlook also weakened. The escalation in trade tariff late August appears to rattle consumers. And that is a very interesting situation. However, this pattern of uncertainty and volatility has persisted for much of the year, and that was a point we made in our presentation. Confidence is plateauing, while confidence could continue hovering around the current levels for months to come. At some point, this continual uncertainty will be a diminished consumers' confidence in expansion. Well, that usually is a little bit harder for consumers to get their hands around. Now, the conference board, this is by Nielsen, a leading provider there of watch consumers buys and watch. The cutoff date for preliminary results was September 13th. So you only had the 1st of September. The consumers' appraisal data conditions was somewhat less favorable in September. Those claiming business conditions are good decreased from 40.9 to 37.3. Not very high. That's below 50%. Those saying business conditions are bad increased from 9.9% to 12.7%. Consumer assessments of the job market were also less favorable. Those saying jobs are plentiful decreased from 50.3% to 44.8%. That is more than a 10% drop. Those claiming jobs are hard to get declined slightly from 12% to 11.6%. Consumers were less optimistic about the short-term outlook. A percentage of consumers expecting business conditions will be better in 6 months. Now declined from 21.6% to 9%. You're going to see further decline. Will worsen, increased those there from 10.2 to 14.3. Consumer outlook for the labor market was also less upbeat. The proportion expecting more jobs in months ahead decreased from 19.9% to 17.5%, while those anticipating fewer jobs increased from 13.7 to 15.7. Regarding their long-term income prospects, the percentage of consumers expecting an improved decreased from 27.7 to 19. However, the proportion expecting a decrease also declined from 6.3 to 5.3. That is the Consumer Board's appraisal. They were formed in 1916. They've been around a very, very long time. Let's move on here. From CNBC, big headline here: consumer confidence falls sharply in September. Basically, we've already said this, but they do cite the Conference Board, and there was the biggest drop in 9 months. September's reading marked the longest shortfall relative to the economists' expectations since 2010. Some say 2009. That's according to Reuters. A little different perspective there. And we already reported what Lynn Franco had to say, and that's the end of that report there. Let's go over GDP and gross domestic product, second quarter, third estimate, and corporate profits, second quarter 2019, and revised, and this was released on the 26th of September from the Bureau of Economic Analysis. GDP increased at 2%. Second quarter there, according to the third estimate by the Bureau of Economic Analysis. The GDP estimate today is based on more complete data. In the second estimate, the increase in real GDP was 2%, and down revisions to personal consumption expenditure, that's PCE, and non-residential fixed investment were primarily offset by revisions to state and local government spending. A little bit of pump priming we used to call it in the old days. Now, we'll look at it here. The real domestic income, this is GDI, increased at 1.8% in Q2 compared with 3.2% in Q1. Average of real GDP and GDI, a supplemental measurement of U.S. economic activity that weighs GDP and GDI, increased by 1.9% in Q2 compared with 3.2% in Q1. Current dollar GDP increased by 4.7%, or 241.5 billion in second quarter, to a level of 21.34 trillion. So you're talking about an economy that at one time was generally at say 15%, and then we had 15%. At 15T, and then we had 18T. You can see where the economy is now at $21 trillion. A very large number there. Nonetheless, $1 trillion here. And let's see, the index of gross domestic purchases increased by 2.2% for Q2 compared with an increase of 0.8% in Q1. The PCI price index increased by 2.4% compared with 0.4%. There, excluding food and energy, the PCE price index increased, and this is inflation here, at 1.9% compared with 1.1 there. So some of the things that happened here, well, sometimes my pointer outdoes me here. Well, to never be found again, I suppose. Where we got that from, we did get it somewhere, no doubt about that. Well, let's go down once more here. Editing will take care of this. They always say that, don't they? Yeah. Anyway, we can look at these numbers here. Real GDP in the advanced estimate was 2.1, and now it's at 2 in the same thing. Current dollar GDP 4.6. It was 4.6, and the third estimate 4.7. Real GDI, well, 2.1. Now it's down to 1.8. The PCE index at 2.0. Corporate profits with inventory valuation, corporate capital consumption increased at 75.8, in contrast to a decrease of 78.4 billion in Q1. Profits of domestic financial corporations 2.5 billion in Q2 compared with 22.2 billion in the first quarter. Profits of domestic non-financial corporations increased at 34.7 in contrast to a decrease of 108.2. The rest of the world profits increased 39.7 billion compared to 73 billion in Q2. Receipts increased 25 billion there. That is the end. This is WBRN Radio. Let me pause just a second here. Well, I finally got back to the chart here. This is personal income. In 2016, it amounted to 16T, and in 2018, it was 17T. And if we look at these various rates on the Q2, it was 18 trillion. This is personal income here in the billions of dollars. Compensation rose to 11. Looking at some of these various things, supplemental anyway, at over a trillion. So in other words, what you're basically talking about in 2018, you had a 17T economy there, and in 18 and Q3 17, almost 18 Q4. So you basically have went to 18,596. So it's a very, very large economy. Very few nations even can get to $1 trillion in the economy. Anyway, that's just some of the basic underlining things out here. And looking at that at farms, let's see where they stand, 35.6 billion and, 19.2 non-farm and non-farm trade. Anyway, this is part of that income here. So now let me roam back here to do the numbers. Nonetheless, let's start in Asia here. Start in Asia. The Nikkei at a negative 169.34 in Shanghai. They were at 3.08. In HIS, they were at a negative 7.12. The AZEX 200 was at 34.50 there. The Kopi, that's Korea, negative 24.59. I think this is New Zealand 50 here. They were 13.57. I have to look over here. Yeah, okay. And in Malaysia, the negative 8.86. In Taiwan, they were at a negative 42.31. As some of the markets in Asia. So let's slide along here and move along here. To the European markets, the FTSE at 75.31. The DAC at 95.40. The CAC, that's in France, at 20.01. The Stasi 600, I think we've given that one before, at 1.84. The X at 0.59. And these are some that we normally don't give in the European markets. Let's see, we have Spain in here. I'm not sure, I don't see it on this one. Anyway, nonetheless, and to the U.S., the Dow was down negative 70.87. NASDAQ was down 91.03. The S&P 500 was down 15.83. The Russell 2000 negative 12.85. The VEX was at went up 1.15 at 17.22. Not a lot of volatility going there. And some of these are more in the Americas here. Bolivia negative 2.41. In Caracas, actually, they were up 13.73. We don't get as much from Caracas. We got Bolivia there, and this is rounded out the America stock markets to petroleum at 56.8. That was the last reading there. A change of 23 cents. Gold was at 1,503 and 30 cents, down $11 basically there. Silver at $17.59. It was down 0.332. Wheat, we usually don't give wheat, but anyway, it was up 2.5 there. And various currencies out there, depending on which one you want to deal with. If you go euro plus dollars, that's changed. Let's see, many euro at basically $1.22 there. Wherever you want to go on that, the basket of currencies we talked about. And we got Shanghai, the bonds, the interesting rate. The 10-year yield at 1.687. The 30-year at 2.131. The 5-year at 1.565. The 2-year at 1.638. And the 3-month at 1.805. And if you want to go to Japan's 10-year at a negative 2.52, it was actually, well, anyway. The yield curve steep after the threat of DJ Trump delisting Chinese firms in the U.S. There. So a steeper yield curve here. Let's see. Yeah, very close. The 2-year is at 1.638, and yeah, and the 10-year is at 1.687. So yeah, the yield curve is beginning to get inverted. It will no doubt get inverted very, very quickly here. And I think I've gotten everyone here. We didn't go to the UK on this particular one. Majority of CFOs believe the U.S. will be in a recession. This is from CNBC next year. Big rotation taking place in the stock market there. Regular investors are cut out of major financial markets. Anyway, flat earnings, the market's best hope in 2019. Some of the little headlines here, what Kramer thinks and what Kramer doesn't think. Well, we're not too interested in what Kramer thinks and what Kramer doesn't think. This is from CNBC. He's one of the characters. Been run through CNBC. The third quarter was a dud for stocks, but the fourth quarter could be full of surprises, no doubt about that. Stocks making the biggest moves are Micron, Wells Fargo, so forth and so on. A lot of Micron here. I said micro. Yeah, a lot of them here. Apple, all those stocks that have exposure to the world are in trouble. And a sinful showdown between wine and weed is brewing. Oh, that's interesting. I suppose the states that are out there. And some questions here. We'll have this hopefully in the next broadcast. Target's the biggest name in retailing, can survive a downturn. That's according to Cowen. We don't know about that. They could or couldn't. I think Walmart. Well, anyway, Disney investors hope for just de-escalation in trade talks. Tech analysts on how to trade Apple around 5G rollout. Well, 5G is rolling out. And Best Buy, like many others, is going in the healthcare business. Could generate up to $46 million. That's according to Morgan Stanley. And we'll see where all of that goes. Everyone is trying to get into healthcare an expanded market. This will do it for us. The this week in economics on the 29th of September 2019. For those in business, make next week a productive one. No doubt will be the first week in October, as this is our last broadcast for the month of September. And consumer, keep your eye on the prize. Evidently, as I understand from Diane G, that some of the retailers have already started the holiday season along with Halloween. This is Halloween clown. Anyway, whatever the story might be. Good day.